The most important mistakes to avoid when investing educate viewers on common investment mistakes and how to avoid them. Investing is a critical component of building wealth and securing financial independence, but it is also fraught with potential pitfalls that can derail even the most well-intentioned plans. Whether you are a novice just starting out or a seasoned investor, understanding and avoiding common mistakes is essential to achieving long-term success. What are the mistakes investors should avoid? This guide highlights 20 prevalent errors that investors should be mindful of, from emotional decision-making and inadequate research to ignoring the impacts of fees and taxes. Number 10. Lack of research. One fundamental error that can seriously compromise an investor's success is not doing enough research. Investors incur needless risk when they make financial commitments without fully comprehending the fundamentals of the investment, including the company's financial standing, market trends, competitive environment, and potential for future growth. Investing without sufficient research is similar to gambling in that choices are made more on chance than logic. Thorough research aids investors in understanding the intrinsic value of an asset, spotting possible red flags, and making well-informed decisions. Additionally, it enables them to match investments to their financial objectives and risk tolerance. Number 9. Emotional investing. Investing based on emotions instead of reason is a common mistake known as emotional investing. Emotions like excitement, greed, or fear are used to drive decisions. This conduct frequently results in high purchases during periods of market euphoria and low sales during periods of market panic, which can seriously impair investment returns. In a market downturn, for example, investors may sell assets out of fear in order to limit their losses, even if the investment's fundamentals hold up well. On the other hand, greed can cause someone to chase after speculative investments or high-flying stocks without doing their research in the hopes of making quick money. Emotional responses may also lead to frequent trading, which further reduces returns by increasing transaction costs and taxes. Creating a disciplined investing strategy with specific goals in mind is essential to avoiding emotional investing risk tolerance and thorough research, and to stick to this plan even during market volatility. Number 8. Lack of diversification. One crucial error that can significantly raise an investor's risk exposure is a lack of diversification. Investors are more susceptible to market swings and the particular risks connected with each investment when they concentrate their assets in one or a small group of investments. For instance, if a stock or industry has a downturn, investing heavily in that stock or industry may result in large losses. Contrarily, diversification entails dispersing investments over a range of industries, geographical areas, and asset classes, including stocks, bonds, real estate, and commodities. Because better performance in one area can offset poor performance in another, this strategy helps reduce risk. By providing investors with access to a wider range of opportunities, diversification can also increase potential returns. It is a cornerstone of risk management with the goal of building a portfolio of investments that is more resilient and stable. A more balanced strategy could have prevented investors from suffering major financial setbacks due to inadequate diversification. In the end, a well-diversified portfolio supports the proverb, "Don't put all your eggs in one basket," assisting investors in obtaining more steady and consistent returns over an extended period of time. Number 7. Overreacting to market volatility. It's common to overreact to market volatility, which can be detrimental to long-term investment success. The term market volatility describes the regular and frequently erratic changes in financial market prices. Investors may act rashly and panic sell during market downturns or buy excessively during market upswings when they respond impulsively to these transient fluctuations. These behaviors, which are usually motivated by greed and fear, result in high purchases and low sales, which gradually reduces the value of a portfolio. For instance, even though the underlying fundamentals of their investments hold true, some investors may sell off their holdings at a loss during a market correction out of fear of further declines. On the other hand, in a bull market, they might make large investments in overpriced assets in the hopes of realizing further gains, only to encounter substantial losses when the market corrects. This reactionary approach disrupts long-term investment strategies and can result in substantial financial setbacks. Number 6. Chasing performance. Investors often make the mistake of chasing performance, believing that investments that have recently yielded high returns will always remain profitable. The lure of previous success frequently motivates this behavior, but it ignores the underlying causes of those returns. For instance, many investors might rush to purchase a stock or mutual fund if it has outperformed the market recently, in the hopes of realizing gains akin to those in the future. But past performance is not a good indicator of what will happen in the future, and using this strategy can result in large losses. Recent strong performance from investments may indicate that they are overpriced due to increased demand, leaving them vulnerable to price corrections. Furthermore, the circumstances that resulted in the impressive performance, such as positive economic trends, industry booms, or exceptional company-specific events, might no longer be present. Investors who chase performance often buy high only to see the value of their investments decline when the market adjusts. Number 5. Neglecting to rebalance. One big mistake that can jeopardize an investment portfolio's efficacy is failing to rebalance. In order to maintain the appropriate ratio of risk to return, rebalancing entails periodically modifying the asset allocation within a portfolio. The initial asset allocation may stray over time if investors don't rebalance because different asset classes perform differently. Let's take an example where an investor initially puts 40% of their portfolio in bonds and 60% in stocks. The portfolio's stock allocation may rise to 70%, while the bond allocation falls to 30% if stocks outperform bonds over time. This change can make the portfolio more heavily weighted toward equities, which could expose it to higher levels of risk than intended. Portfolio's allocation to those assets may decline below the desired level. This can lead to missed opportunities for growth if those assets eventually rebound. Number 4. Market timing. Taxes on dividends, capital gains, and interest income can lower your returns, so it's important to not underestimate their impact. Make use of tax-advantaged accounts, such as 401(k) and ONIX and IRAs, and think about investing strategies that minimize taxes. Number 3. Lack of a plan. Decisions made in the absence of a well-defined investment plan may be erratic and influenced by market noise. A plan aids in goal setting, risk tolerance, and goal-achieving tactics. Number 2. Ignoring inflation. Ignoring inflation is a crucial error that over time can reduce the buying power of investments. The term inflation describes the general upward trend in prices of goods and services over time, which causes the value of money to decline. Investors may underestimate the rate of return required to preserve the same level of purchasing power in the future if they do not factor in inflation. Assume, for instance, that an investor receives a 5% yearly return on their capital. The real return, or return after accounting for inflation, is essentially zero if the rate of inflation is 5% as well. In this case, the investor's purchasing power stays the same even though their investment balance may grow nominally. In actuality, in order to generate returns, the investor would need to exceed the rate of inflation. Number 1. Overconfidence. A common behavioral bias that can cause investors to overestimate their skills and take unwarranted risks in the financial markets is overconfidence. It entails having an unjustified faith in one's abilities, knowledge, or judgment, which frequently results in less than ideal investment choices and outcomes. The idea that one can regularly outperform the market by making profitable investments or correctly timing the market is one example of overconfidence. Investors who are overconfident may trade frequently, chase after trending stocks or industries, or place speculative bets based on insufficient information. On the other hand, studies have repeatedly demonstrated that most individual investors underperform the long-term market indices. Believing in your ability to consistently pick winning investments can lead to excessive risk-taking. Acknowledge the role of luck and randomness in investing and adopt a humble approach. In summary, avoiding these common mistakes is essential for investors to build a successful and resilient investment portfolio. By conducting thorough research, controlling emotions, maintaining proper diversification, and staying disciplined in their investment approach, investors can enhance their chances of achieving their financial goals over the long term. It's crucial to remain mindful of the potential pitfalls such as overreacting to market volatility, chasing performance, neglecting to rebalance, ignoring inflation, and succumbing to overconfidence. So if you like our video and you want more similar topics to see in future, then subscribe to our channel.